All right, let's talk about fire insurance. It's that safety net we all have for our homes, our businesses, basically our most valuable stuff. And look, we all hope we never, ever have to use it, right? But today, we're going to dig in and make sure you really get what it does, and just as importantly, what it doesn't do. So think about it for a second. You've got insurance. But are you really covered if a fire hits? It seems like a simple enough question, but trust me, the answer can get pretty complicated. See, just having a policy isn't the same as having the right coverage. So let's dive in and figure out what exactly that policy of yours is promising. Okay, here's our game plan for today. We'll start with the basics. What even is fire insurance? Then we'll get into what legally counts as a disaster, which is super interesting. After that, we'll decode your policy, talk about what happens when you need to recover, and finally, we'll look at the bigger picture of risk. All right, first up, what is fire insurance? Let's get right back to basics. At its core, this whole thing, this contract, it's really just a fundamental promise of protection. So here's the official definition. I know it sounds a bit formal, but there's a really important word in there: indemnify. That is the absolute heart of insurance. All it means is that the company's job is to make you financially whole again. The goal is to get you back to where you were right before the fire, not to let you make a profit off it. And see that part about defined property? That's crucial too. It means they only cover what's specifically written down in your policy. No more, no less. Now, you can't just go and take out an insurance policy on your neighbor's house, right? You have to have what's called an insurable interest. It's a fancy way of saying you need to have some skin in the game. You have to have a direct financial stake, meaning you'd actually lose money if it got damaged. Obviously, this means the owner, but it can also be the bank that holds the mortgage or even a warehouse keeper who's responsible for the stuff inside. If you stand to lose, you have an interest. Okay, so you've agreed to the policy, you've shaken hands, but that big, thick, official document hasn't arrived in the mail yet. So what happens in that gap? Well, that's where something called a cover note comes into play. Think of it as your temporary proof of insurance. It's the official piece of paper that says, yep, you're covered, while the insurance company is busy getting all the final paperwork sorted out. It's like the official temporary handshake. Okay, on to our next section, and I gotta tell you, this is where things get really interesting. You might think, fire is fire, right? Well, in the world of insurance, not so much. The legal definition of what actually counts as a fire for a claim is super, super specific. And here's the key distinction. On one side, you've got what insurance calls a friendly fire. Think of the fire in your fireplace. It's doing what it's supposed to do, staying where it belongs. That's not what insurance covers. What it does cover is a hostile fire. This is a fire that has broken bounds, one that's escaped from where it was meant to be. We're talking about actual ignition, real flames, not just, a bit of smoke damage because something was too close to the stove. It has to be out of control. But here's the good news. The coverage usually goes way beyond just the stuff that got burned. It often covers damage that's a direct result of the fire. So think about it. All that water damage from the firefighters' hoses? Covered. Your stuff getting broken while people are rushing to get it out of the burning building? Covered. Even the damage from pulling down a wall to stop the fire from spreading, that can be covered too. It's all considered part of the same event. Now, for the flip side, you've got the exclusions, the stuff that is typically not covered. And you really need to know these. For instance, fires caused by things like war or riots are almost always out. What about theft during all the chaos? Usually not covered by the fire policy. And here's a weird one. Damage from something spontaneously combusting or from a lightning strike that doesn't actually start a fire? That's often not covered either. The big takeaway here? You've absolutely got to read the fine print. All right, let's get into the part that really matters, the money. This next section is all about the clauses in your policy that directly affect your wallet. These are the rules that determine exactly how much you'll get if you have to make a claim. So let's break them down. First up is the average clause. This is one of the most important clauses you'll find, and honestly, it's one that a lot of people don't quite get. The whole point of it is to make sure you insure your property for what it's actually worth. Because if you don't, if you underinsure it, you basically end up acting as your own insurance company for the part you didn't cover. You'll see what I mean in just a second. Let's make this real with an example. Say your property is worth 40,000 rupees. But to save a little money on the premium, you only insure it for 30,000. That's only 75% of its total value, right? Now, disaster strikes, and you have a loss of $20,000. You might think, great, I'm insured for $30,000, so they'll pay the full $20,000. But nope, because you only insured 75% of the value, the insurance company will only pay 75% of your loss. So they'll give you 15,000 rupees, and you are on the hook for the other 5,000. That's the penalty for underinsuring, and it's exactly why keeping your property's valuation up to date is so important.
So what happens if you have, say, two different insurance policies on the same property? Can you just claim the full amount from both companies and double your money? Well, no. That would be profiting from a disaster, and that goes against that core idea of indemnity we talked about. This is where the principle of contribution kicks in. It basically forces the two insurance companies to talk to each other and share the cost. They'll each pay their fair share of the loss, making sure you get back what you lost, but nothing more.
Okay, so let's imagine the worst has happened. The smoke has finally cleared, and you've filed a claim. Now what? How does the insurance company actually make good on its promise to get you back on your feet? Well, one way they can do it is through something called reinstatement. Instead of just writing you a check for the damages, the insurance company has the option to actually step in and repair or rebuild the property themselves. Now, this can be great because you don't have to manage all the contractors, but it can get tricky. The cost to rebuild could end up being more than the total amount you were insured for. Plus, if the final result isn't a perfect match to the old one, it can lead to some disagreements. But what about things that are hard to put an exact price tag on? You know, maybe a one-of-a-kind piece of machinery or a unique work of art gets damaged. How do you measure that loss precisely? It can be almost impossible. That's when a rule of fairness, called the Doctrine of Approximation, comes into play. It's a way of saying, look, we can't get this down to the last penny, but we're going to do our best to come to a fair and reasonable number to compensate you. And here's how that usually works. It's pretty logical, actually. First, they'll figure out the true value of the property right before the fire. Second, they'll look at what's left and see if anything has salvage value. You know, can the scrap metal be sold? Can any parts be reused? They take that salvage value and subtract it from the total value. The number they're left with is your net loss, and that's what the insurance company will pay you, as long as it doesn't go over your policy limit. Okay, as we start to wrap things up, let's zoom out a bit and look at the bigger risk picture. We're going to clear up two terms that people often mix up, and then see how fire insurance fits into your whole protection plan. So, double insurance versus reinsurance. Here's the simple way to remember it. Double insurance is something you, the customer, might do, taking out multiple policies. Reinsurance, on the other hand, is something your insurance company does for itself. Think of it as insurance for the insurer. To protect themselves from a huge, catastrophic loss, like an entire factory burning down, your insurance company will sell off a piece of that risk to another company. It all happens behind the scenes. You'll probably never even know about it. And of course, it's so important to remember that fire is just one type of risk out there. You have to see fire insurance as just one piece of a much larger financial shield. Other policies, like, say, burglary insurance, are another key piece. They protect you from a totally different threat, theft. The goal is to put all these pieces together to build a really solid safety net for your most important assets. So that brings us right back to where we started. Your policy is a promise. After everything we've talked about today, from what legally counts as a fire to how that tricky average clause works, do you know exactly what your policy is promising you? The single most important thing you can do now is go and actually read it. Because it's not just a bunch of paper. It's a critical promise. Make sure you know what's in it.